Very warm welcome to the Oxford Martin School. I'm Ian Golden, the director. Delighted to see so many of you here for our talk by Andy Haldane. Andy is the Executive Director for Financial Stability at the Bank of England. In my view, he has three wonderful merits. Firstly, he is, I think, the most analytically deep and profound thinker in central banking around the world today, and certainly in the UK, who writes and his team works with great analytic rigor on the issues which are most important and relevant to the stability of the financial system. So he gets, in my view, full marks for analytic rigor. He is also the most eloquent of these writers and thinkers, and has an ability to transcend the normally rather dull language of central bankers to write with a style and ability which enables ordinary people to understand what he's saying, and also to amuse academic and other writers. So this eloquence, which leads to a whole series of papers with wonderful names like The Dog That Caught the Frisbee and The Fish in the Fishbowl and many others, which I commend to you on the Bank of England website. And his papers is something which is very unusual and most welcome. And thirdly, he's inquisitive, voraciously so. He's interested in making connections. Just today at the Oxford Martin School, he's been speaking with our colleagues who work on black holes and citizen science, as well as complexity. He's interested in behavioral economics, he's interested in psychology, anthropology. I've heard him in various forums talk about philosophy, many other things. And this inquisitiveness allows him to think as an interdisciplinary thinker, which is extremely rare, bringing the best of many disciplines to the thinking about the global financial system and the British financial system. I think we're incredibly lucky in the UK and the Bank of England to have someone of his capacity at the forefront of thinking on global financial stability and the UK's financial stability. And so his role as executive director is extremely central, I think, to how our lives are likely to pan out and the lives of the UK bankers and financial system. So it's an absolute delight to have Andy here today. He'll speak for about 45 minutes, and then we'll have a question and answer session. Andrew, you have the floor.
So, thank you. Can you all hear me, by the way? Does that work? Thank you, Ian, for that incredibly kind introduction. Too kind, actually. And thank you all for turning up today. It's a real pleasure to be at the Oxford Martin School. As Ian mentioned, I have been begging, borrowing and stealing. That's better, right? You can hear me now. I have been begging, borrowing and stealing ideas from other disciplines for a number of years now, and no less than over the last few years, where we in the area of economics and finance have had a real job in trying to make sense of the chaos and in crafting policies to avoid the chaos. And it's been key, fundamental, to be able to look outside of economics and finance for solutions. And the Oxford Martin School is the sort of place towards which we would look for such solutions, and I have looked for solutions. So it's a great pleasure to be here. I want to ask today, I hope, quite a big question, and this is it. Is the global financial system safe? I'm going to reach a fairly obvious conclusion, because if the answer was yes, the next 45 minutes will be a bit less interesting. So the answer is going to be no, but it's going to be no in a specific respect. I want to start with a lesson. So, what have been the key lessons from the financial crisis of the last 4 or 5 years? There are plainly many. They are many and varied. But I wanted to pull out one of the key ones, I think, from my perspective, and it's the one given here. That we should seek to manage the financial system as a system. Now, I know what you're thinking. Isn't that completely obvious? And the truth is, it is completely obvious. Or at least after the fact it's been obvious. But at the same time, much of the pre-crisis orthodoxy among bankers, among regulators, was not to think in this systemic way. Indeed, we convinced ourselves pre-crisis that it was both necessary and sufficient for stability to ensure that each individual bank, each individual node in the network was safe and sound. That was felt to be necessary and sufficient to safeguard systemic stability. And how wrong we were. Because in truth, what events have shown is that that is neither necessary nor sufficient. Individual nodes, individual banks should fail. Their individual safety is not necessary to preserve the stability of the system. What's more, even if each individual node is safe and sound, that by itself does nothing to guarantee or safeguard system-wide stability. Each of the blocks in the tower may look robust, but the tower itself might not be, and indeed was not. And therein lay one of, if not the key, intellectual fault lines that underpinned the crisis that befell us 5 or 6 years ago. Now, the good news is that, at least in respect of international banking, that lesson appears to have been largely learnt. We are now acting as regulators, as risk managers, in a way suggested by that sentence. We are seeking to regulate with an eye to the stability not of any individual node or bank, but with an eye to the stability of the system as a whole. That's why we're requiring the world's biggest banks these days to hold more insurance, bigger buffers against rainy days. Why? Because they are super spreaders that otherwise risk bringing the system to earth, as happened after the failure of Lehman Brothers in 2008. That is why so much effort is being put into the resolving, the orderly winding down of the world's biggest banks, especially when they cross borders. We have found religion on the importance of systemic risk when it comes to banking. That is why we now have international banking rules. That is why we have something that is a discernible architecture for dealing with international banks. So far, so good. But there is a second aspect to financial stability where this principle, somewhat remarkably, has not been taken to heart to date. Because once we move from the banks being the nodes to countries being the nodes, and once we move from the international banking system to the broader international monetary and financial system, what we quickly find is there are no rules of the road. There is no real architecture for managing, coordinating actions across countries when it comes to the design of the international monetary and financial system. We have no international rules of the road. The key lesson that we should have learnt from the crisis is still with us, which has been learnt for banking, has not yet been applied to the management of the international monetary and financial system more broadly. And that's going to be the theme of my talk today. And if we lead examples of this gap, this missing link, this intellectual fault line, we need look no further than events over the past 6 months, indeed no further than events over the past week for examples of that. So 6 months ago, the US Federal Reserve embarked on a program of so-called tapering, progressively talking about turning off or slowing down the rate at which they supplied additional money to the US economy. When they first floated this idea back in May last year, that's the dotted line here, all hell broke loose, especially in the emerging market world. And this blue line here shows flows to emerging markets either side of that so-called taper talk. The spillover was pretty immediate and pretty dramatic and has continued to date. And if you read the Financial Times last week, you will have seen that those stresses have continued to pick up pace in a bunch of countries, including most recently in India, in Argentina, in Turkey, in South Africa, all of whom have seen their exchange rates fall, that's the left-hand side picture, and their bond yields rise as a response to stress created elsewhere in the system. Direct financial spillovers from one country to another country. What is the state of this debate right now? Well, it is an argument between the advanced economies who are saying to the emerging markets, get your house in order. Your fundamentals aren't sound. You are fragile. Sort it out. And the emerging markets who are saying, be careful what you do with monetary policy. Because when you tighten or even talk about tightening, the effects lap back and spill over in ways that adversely affect us. What is going on with that head-to-head combat is people pursuing policies for individual countries, when in fact what's at stake are the fortunes of the system as a whole. In other words, that key lesson learnt to us painfully through the banking crisis has not been learnt when it comes to managing the broader global monetary and financial system. We are having individual countries act in their own best interests without taking much, if any, account of the broader implications of that for the system as a whole. And therein lies the gap. Therein lies one area of unfinished business when fixing the problems of the global monetary and financial system. So when I talk about that problem, its origins, how easy it would be to put in place solutions, what needs to be done to get to something that is a discernibly architectural solution to what is a systemic problem. So let me start a little way back. What are the origins of this problem? Why has this become a greater problem? Why are these spillovers a greater problem now than at any time in the past? So this chart looks at a measure of global integration. Integration of trade in goods and services, that's the blue blob, and financial integration, trade in financial assets, here measured as the stock of external financial assets to GDP and the flow of global trade relative to GDP over a fairly lengthy window. This is over the last 140 years or so. What are the key takeaways from this chart? Well, look towards the end. There has plainly been a very material increase since around 1980, 1990 in the degree of both cross-border integration of trade and of finance. In fact, looked at over the historical sweep, the level of global trade and financial integration is at levels never previously seen, including back in the previous golden age at the end of the 19th century of the classical gold standard. So we've seen a rapid pickup in global integration on both the trade and financial side. And that pattern has been particularly dramatic on the financial side. So back in 1980, so measured, trade integration and financial integration were pretty much level pegging relative to world GDP. Over the 30 years so since, financial integration has headed north at a real rate of knots, while trade integration has picked up at best gently, so that we find ourselves 30 years on with financial integration so measured being almost 10 times that of trade integration. So a dramatic, very dramatic pickup in the extent of cross-border flows of funds internationally. Or in other words, global financial integration has gone through a revolution globally over the last 30 years or so. Let me demonstrate that in a slightly different way with this picture, which I'll build up. So this is a different measure of global financial integration. It doesn't measure the stock of assets flowing cross-border. Instead, it looks at the correlation between domestic saving rates and domestic investment rates in a set of countries. Now, if the world was completely autarkic, if there was no integration of financial flows cross-border, then any domestic investment would need to be fully financed with domestic saving. In other words, the correlation between saving and investment would be 1. And that's the lower dotted line here on this chart, which measures financial autarky. By contrast, if we were in a world of perfectly integrated capital markets, then you could finance your domestic investment from overseas. The correlation between domestic investment and domestic saving would be close to 0, which is the upper dotted line here. So by measuring the correlation between saving and investment over time and across countries, we have an indirect metric of the degree of international capital market integration. So how do those correlations look over the last 130 years or so? Well, here's the first period, which is really that golden era I mentioned, prior to the Great Depression, when the classical gold standard was in place and cross-border flows of capital were felt to be large. The capital accounts of most countries were fairly well liberalized. And over that period, on average, that correlation between saving and investment was around 0.5, somewhere between autarky and capital market nirvana, between the two dotted lines. What happened immediately after the Great Depression was that restrictions on capital movement across country came into place. We went through a period in the interwar years, but right through until the early 1980s, when global capital market integration, so measured, was very low. The red line now is very close to the financial autarky line. And around the early 1980s, that prompted a couple of economists, Feldstein and Horioka, to point to what they called the puzzle, the Feldstein-Horioka puzzle, which is why even 10, 15, 20 years after financial liberalization, these measured levels of integration were still so low. Well, at just about the time that they were writing their paper on this puzzle, the puzzle disappeared. The pattern reversed, the line headed north towards capital market nirvana of one, and indeed just before the crisis came within spitting distance of perfect capital market integration. And let's come off a bit since the crisis. Nonetheless, we are still on this measure operating at a degree of global capital market integration that has no historical precedent. The degree of global financial integration is at net levels never previously seen. So, the next question is, so what? If that is the case, do we view that as good news or as bad? The answer to that is both. Both. Because one thing we know, or think we know, from thinking of global finance as a network is that integration, joining up, connectivity within that network is a double-edged sword. It comes with both costs and benefits. So the key benefit of that interconnectivity is that it allows the network to act as a mutual insurance device. So when nasty things happen to a country, a bank, any node, the interconnectivity is a mechanism for sharing that pain around the whole web. A problem shared is a problem halved, or perhaps even more than halved. And that is true most of the time. In fact, it's true apart from when it's not. And the not is very important, because if the pain felt by any bank or node or country is sufficiently acute, then that mutual insurance device instead turns into a mutual incendiary device. Risk sharing becomes risk spreading. It is the phenomenon known as contagion. It is those spillovers that I mentioned just at the beginning. We find in the language of physicists that integrated, joined up, connected webs exhibit this robust yet fragile property. Robust in the risk sharing zone and fragile in the risk spreading zone. They exhibit a knife edge property, a tipping edge property, which means that this web can appear robust for lengthy periods. Shocks can come and shocks will be diffused. It will have the appearance of being robust, but it also has a fat tail when that risk sharing property goes into reverse. This is a property we see in all sorts of webs. I mentioned some of them here. Ian in his various books has discussed them at some length. There is a clear manifestation of this robust yet fragile property when it comes to the financial system. We went through an era of 20 or 30 years when we appeared to have solved the problem of boom and bust. Remember people talking about that? Remember politicians talking about having removed boom and bust? But we thought that the financial system had scattered risk to the four winds, had diversified risk away in a way that made both the economy and the financial system more stable and robust than it ever had been previously. This was the period that we hilariously called the Great Moderation. What we saw is that great moderation, that robust period, gave way very quickly to a period now known as the Great Recession. We fell off a cliff. The financial system and economy globally fell off a cliff, which was evidence of this interconnected web moving from risk-sharing mode to risk-spreading mode. So to show it diagrammatically, this is a simulation from a little model. Systemic risk running vertically up the y-axis. We've got some measure of the financial strength along the x-axis, and up the z-axis some measure of financial integration. It's a simulation of a hypothetical model, but illustrates the point. So risk going vertically, financial strength running left to right, and financial depth, if you like, running up the z-axis. Over this period, I've been told not to walk around the screen, but it's too late now. This is the Great Moderation period. So financial integration picking up and banks appearing strong. Regulators globally spoke about how strong, how resilient, how well capitalized global banks were. And we told a story also about financial integration having diversified away risk. All regulators globally were telling this tale right up until 2006, 2007. And of course it had some truth to it, because we were operating in this yellow zone, this period of, this zone of tranquility, where risk sharing was operating. What happened in 2007, 2008, right up until the present day, is when the big one came, however, risk sharing became risk spreading, the knife edge kicked in, and we jumped instantly to a much greater level of systemic risk than ever previously seen. This is the cliff edge that follows from greater integration, the cliff edge that we fell off in 2008. So the implication here is that a more globally integrated world some of the time is terrific and other times is terrible. It will lead to long zones of tranquility, the yellow zone, the Great Moderation, punctuated, however, by crises, catastrophes, that arise both more frequently and are on a larger scale than ever previously seen. We are entering a world where the tail is much fatter than ever previously seen. The tail in the economy and the tail in the financial sector. Evidence. Well, here's some evidence. So the green lines here just measure that metric of capital market integration. External liabilities relative to world GDP. That's gone up a lot. What has happened over the same period? Well, crises, whether banking crises, blue, or financial crises generally, red, have risen in lockstep. No great surprise if you buy my story. Not just the instance of crises, but also their scale. Here's a measure of the size of IMF programs since around the end of the Second World War. Relative to quota, they have, surprise, surprise, been on a secularly upward rising trend. Both the probability and the impact of global financial crises has been on the rise. That is the cliff edge effect of integration, global financial integration at work, the dark side of integration that sits alongside the light side. So where does that leave us? What are the implications? If you buy that story, what implications follow from it for the our understanding and for our management of this global system. Well, let me mention two, the first of which I'll touch upon briefly. The first, I think, more research question, which will be relevant, I think, to at least some of you in the audience, is how do we know what degree of integration, of financial depth, makes most sense from a productivity and growth perspective? So if you read the evidence on the implications of greater capital market liberalization, the evidence reaches a rather mixed conclusion. Unlike on the trade side, where the evidence suggests overwhelmingly that trade liberalization is good for growth and productivity, the evidence on the capital accounts, on the financial side, is much more mixed. And that's true also when we ask ourselves the question, how large could or should the financial sector be? So up until, I'd say, the crisis struck, the working assumption, the orthodoxy, if you like, from the literature, was that financial depth was good for growth. So this upwards, this is a measure of financial depth, private credit to GDP, across a bunch of countries over the last 140 years or so. This blue line shows the steadily upward rising path of financial depth globally. That was generally felt to have been growth positive, and lots of cross-country studies suggested this financial deepening was indeed positive. But the last few years have led to a bit of a questioning of whether it might be possible that you could have too much of a good thing. Is there a scale of the financial sector at which those growth positive effects begin to taper out, perhaps even go into reverse? So the Bank for International Settlements and the IMF have recently both done studies, cross-country studies, that suggest that this relationship between financial depth, here on the x-axis, and growth or productivity, here on the y-axis, might be this inverted U-shaped pattern. You may indeed get too much. You can have too much of a good thing. I'm not saying this evidence is by any means definitive, but it's at least illustrative that there is an open research question about how much capital market integration and how much financial sector depth is optimal for long-term growth and productivity. The second issue, and the one I wanted to spend more time on, however, is what are the policy implications of the story I have told? If we have moved to a world of historically unprecedented degrees of integration, and if that world is more susceptible to crises and fat-tailed risks, what can be done and what should be done about it? Does the global financial system have adequate insurance in place at present against those risks? And if not, what would be suitable insurance to try and make the global financial system safe? So, let me start with the good news. 4 reasons to be cheerful about the amount of insurance in place globally to guard against those crises risks. I'll go through these in turn. We have seen some improvement in the composition of capital flows, some improvement in the amount of self-insurance that countries have put in place by holding reserves. We have seen some increase in the availability of financing from the IMF and from bilateral sources to guard against those risks. So let me walk you through those 4 positives, each of which should give us a degree of comfort that the world might not be as risky as the one I just made out. So first of all, this looks at a breakdown of the flows of capital to advanced economies, top panel, and emerging markets over two windows, 80 to 94 and 95 to 2012. Broken down between FDI, foreign direct investment, portfolio equity investment, and debt. And the key message I ask you to take away from this picture is that, generally speaking, for both advanced and emerging markets, the share of FDI in total capital flows has gone up, and the share of debt in total capital flows has gone down. And generally speaking, most studies would suggest that that's a positive change in the composition of capital flows, because FDI tends to be long-term and sticky, and debt, especially short-term bank debt, tends to be flighty, and therefore more long-term stuff and less flighty stuff is good from a crisis perspective. One reason to be cheerful. The second is if we look at how much self-insurance, how many reserves, foreign currency reserves, are being held globally. This looks at a measure of international reserves relative to world GDP since the end of the Second World War. It has been on a steadily and strongly upward trend, especially since the Asian financial crisis in 1997-98. Why is that? Because countries have chosen voluntarily to set more aside, to put more in their back pocket in case they hit a future financing problem. So total reserves have increased very materially relative to world GDP. And the financing available from the IMF to help countries that hit crisis, again measured relative to world GDP, has also picked up, particularly since 2009, when there are additional bilateral contributions made to augment the IMF's coffers. And the fourth dimension is that in addition to these multilateral IMF sources of financing, what we've seen over the last 10, 15 years is the emergence of regional financial arrangements between blocks of countries to help one another out in times of need. So within Europe, we've had created most recently the European Stability Mechanism. That's the first blob here. The second is the Chiang Mai Initiative, which is an initiative to share reserves among central banks within Asia. We have similar schemes in Latin America and in parts of the Middle East. So augmenting these IMF sources of financing have grown up in the last 10 or so years, regional sources of financing in addition. So for those four reasons, the picture might look somewhat better than the one I painted at the outset. So let me turn then to the bad news, which is four reasons to be doubtful whether even that degree of insurance is adequate to meet the crisis needs I mentioned. So the first reason to be doubtful is that although international reserves held by individual countries have picked up relative to world GDP, if instead you measure them relative to external liabilities, the potential drawing that might be made on each country, that line heads not upwards over time, but downwards over time. If anything, relative to the degree of global capital market integration, reserves have fallen in aggregate. What's more, those reserves are increasingly being held by a relatively small number of countries. This is a measure of the degree of concentration in reserve holdings internationally. And that measure of concentration has picked up roughly threefold over the last 20 years or so. The reserves are increasingly congregating on the balance sheets of the People's Bank of China, or the Bundesbank or the central banks across the Middle East. And what's more, where those reserves are being concentrated is not necessarily where the need is greatest. And one way of demonstrating that is measuring the ratio of a central bank, a country's foreign exchange reserves to its short-term external debt. So if you're holding large reserves relative to your short-term financing needs, you're in a good position. If that ratio is low, you're in a vulnerable position. If you look across a bunch of emerging markets given here, you'll see that that ratio is very unevenly distributed indeed. For many countries, that ratio is well below this magic threshold of 100%. In other words, they hold insufficient reserves to make good even the short-term claims that may fall due on them over a 6 to 12 month window. So we have this build-up in reserves has both been uneven and has not necessarily been focused on those countries that might most need them as a precautionary insurance device. And moving from reserves to official financing, this measures official facilities, IMF facilities, now relative not to world GDP, but again relative to external liabilities. And that trend too now looks the opposite way around, that IMF facilities, IMF financing, relative to potential demands on that financing, has, if anything, over the last 30 years or so, being headed downwards rather than upwards. If you added on bilateral sources and regional resources, which is what the green and orange line do here, that pumps up the amount of available resources. But even with those added in, you'd conclude that the pool of resources available officially to help countries in crisis is no greater than it was 30 years ago. Over the same period, we know that the probability, or we think the probability and impact of crisis has picked up. So if anything, this insurance looks skimpy relative to what might be required. So far, so bad. The next obvious question is, if this is a problem on the scale I have made out, what's to be done? What could be done of a policy nature to better ensure these sorts of fat-tailed crisis risk that we've seen materializing as recently as last week or so? And there are four things I wanted to conclude on that I think could and perhaps should be done to better guard against the future incidents of country-level crises. And they are an improvement in our ability to spot these problems in advance, the spillovers across border, an improvement in the underlying debt structure of the countries concerned, enhancements in our ability to manage those flows of funds cross-border, and a possible augmentation in the pool of resources available to countries that hit these financial difficulties. So let me briefly touch upon all four of these. None individually, I don't think, would be adequate to meet the scale of the problem, but each individually would, I think, make a contribution towards improving the situation we find ourselves in just at the moment. So starting with improved crisis spotting, an improved ability to monitor the global monetary and financial system as a system, going back to those words with which I started. Because what exists right now is a global monitoring device which is not really multilateral at all. It's largely unilateral. Progress has been made, in particular by the IMF, over the last few years, to put their risk monitoring, their surveillance, on a more multilateral footing. I mentioned some examples here. For example, since 2011, nudged by some countries, including the UK, the IMF started publishing so-called spillover reports. What were they about? They were asking the IMF to assess the impact a given country's policies would have not just on that country, but on the broader global monetary and financial system. Something that had not and was not done previously. That is clearly progress. That's clearly managing, or at least monitoring, the financial system as a system. So where are we still, however, falling short? Well, despite that progress, if you look at the activities, say, of the IMF, you'll find that the majority of the resource is still focused on individual countries. There are these things called Article 4s, which are annual assessments of individual countries by the IMF, each of their membership. They are hugely resource intensive, and they are principally country by country focused. They fall foul of the very critique with which I started. They are node by node. They are country by country, with relatively little focus on the cross-border spillovers of a given country pursuing a particular policy. And this problem of capturing spillovers is particularly acute when, if you're the IMF, the advice you are giving is to a big country rather than a small one. It's all very well being brave with a Cyprus or an Iceland. It's rather harder when it comes to members of the G7. Ruthless truth-telling about the cross-border spillover consequences of nationally oriented policies is much harder when you're dealing with the biggest boy in the playground. And that has been one of the lessons, I think, of the IMF throughout its existence. So, can and should the IMF seek to do a better job of telling a joined-up, integrated, system-wide assessment of what is going on? Yes, has progress been made? Yes, is much more needed? I would say absolutely, if we are to monitor this system as a system. If the IMF is not doing that, then who is? Secondly, debt structure. So the crises we have seen, certainly in emerging markets, but also, especially recently, in advanced economies, have been crises sourced, rooted in too much debt, often in too much debt being borne by the government sector, the sovereign sector. We had a spate of crises, as you know, through the emerging market world in the latter part of the 1990s and the early part of the noughties, and that enveloped Asia, Latin America, Russia. In response to that, actions were taken to begin to put in place little bits of global architecture. For example, it was agreed in the early part of this century that it'd be a good thing for governments to place in their bonds these things called collective action clauses, which made it somewhat easier to restructure debt. It made it easier to bind in all the investors, all the creditors, in the event of you wanting to write down your indebtedness. And some progress was made on that front. Some progress was also made by the IMF in its assessment of how sustainable a debt burden might be for a country. But once again, I'd say there is ample scope for further improvement. The fund made relatively little noise about the growing indebtedness across parts of Europe ahead of the euro crisis. Its debt sustainability analysis in that event fell somewhat short. And for those of you who followed it, this introduction of collective action clauses has not prevented, in some cases, some creditors holding governments to ransom if they try and restructure their debt, as the recent case of Argentina makes clear. What I conclude from this is that we are still quite some way away from having debt structures internationally that are remotely crisis-proof, that further bits of international architecture, for example, for restructuring sovereign debt, might be needed. It's also the case, I think, that emerging markets, and indeed advanced economies, could themselves put in place greater amounts of self-help. They could seek to issue instruments, debt instruments, that do a better job of sheltering them from the crisis storm. And one example of that would be this thing I mentioned in the penultimate line, which is securities where the coupon, the interest payment, and the principal are explicitly linked to income, to GDP in that country. Why is that a sensible idea? Because then you have built-in self-insurance. If you have a nasty shock to your capacity to pay, to your GDP, the interest payment goes down and eases the refinancing burden. So as an example of that, here's a simulation. Imagine the G7 countries had issued GDP-linked bonds rather than conventional securities. What difference might it have made over the period 91 to 2011 in the variability of their debt to GDP ratio? Well, this chart illustrates the answer. Comparing the two red blobs, the variability, the uncertainty in the debt to GDP ratio would have almost have halved had we had these GDP-linked self-insurance securities in place rather than the conventional ones. And of course, if that had been true for emerging markets, for whom the variability in GDP is even greater, then the savings would have been, on average, I think, greater still. So there are innovative ideas out there for helping countries, both advanced and emerging, to do a better job of protecting themselves from shocks to GDP and shocks to interest rates. Third, improved capital flow / macro-prudential management. Over the course of the last 20 years, the IMF has gone through an elegant 180 in its views on the efficacy of capital restrictions. So I've taken two quotes here to illustrate this elegant 180. As with all good regulators, that 180 has been achieved 1 degree at a time, very slowly. But if you compare and contrast these two statements, they are the difference between black and white. The official IMF position now would be that there are circumstances in which it does make sense for countries to protect themselves from the storm by selectively putting in place restrictions on the ability of capital to flow in or to flow out. And they have given even greater support to measures of a macro-prudential nature. That is to say, regulatory policies that may seek to strengthen the financial sector, slow down credit growth, or slow down capital flow movements in or out of a country. Many regulators, most regulators these days, would be macro-prudentialists. They would sing the virtues of a macro-prudential orientation to policy, curbing the booms and cushioning the busts in the way regulatory policy is set. The problem we face is not that these things aren't now on the table, because they are. More than 40 countries have put in place capital flow restriction measures over the last 2 or 3 years. And many more countries have taken macro-prudential measures of various types. Here's just one or two by way of example. The problem we face is not that it's not happening, it's that it's happening in an uncoordinated fashion. It's happening country by country. It's happening in atomistic, node by node fashion. We are not managing these policies as a system. We have no rules of the road internationally for when these policies make sense, how they should be executed, and when they should be exited. And that is one of the many missing links that we should seek to forge, I think, in the period ahead. And finally, let me say something about official sources of financing. Again, there is some good news to report. The stock of IMF resources has nudged up. Some new IMF facilities have come on stream. And augmenting those, we have, through the crisis, seen central banks open up their balance sheets on a bilateral basis to some other countries. So in the thick of the crisis, the Fed began to extend dollars to a range of other countries, both advanced and emerging. And as recently as the end of last year, it was agreed among 6 countries, US, Canada, Switzerland, Euro area, UK, and Japan, to put those bilateral swap lines on a permanent and unlimited basis. To swap, be it sterling for dollars or dollars for euro, on a bilateral basis as and when countries might need them. That is progress, but the progress has undoubtedly been pretty staccato and fairly slow. To give one example, these multilateral swap facilities extend among the G6 advanced economies, but do not extend to those emerging markets who might be most in need of dollars. So one question is whether some of these facilities ought not to be augmented or extended in ways that might mitigate the crises I've been speaking about. Back in 1999, Stan Fischer, then Deputy Managing Director at the IMF, now hopefully to be Vice Chairman of the Fed in the US, spoke about the need, or made the case, for the IMF becoming a genuine international lender of last resort. Over the period since then, since 1999, the IMF's capacity, so to do, has, if anything, diminished at the same time as the risk has increased. It might be time to dust off Stan's speech and see whether his suggestion then might not bear some further looking at today. I've run through, I hope, and I'm realizing I'm over time, where I see the state of the international monetary and financial system today. It is ironic that the big lesson we have taken to heart on the international banking sphere has been largely ignored when it comes to the monitoring, management and regulation of the international monetary and financial system. That chasm needs to be closed before any more countries find themselves imperiled in the way we've seen over the last 2 weeks. That calls for a radical reform agenda, an agenda every bit as radical as that which we've seen on the regulatory side over the last 4 or 5 years. There is plainly unfinished business if we are not to live again the crises of the past. Let me stop there. Thank you.
great, Andy. As always, you didn't disappoint, and certainly were able to bring together an amazing array of data, which I think you're well known to do in all your talks. And I certainly am convinced, again, if I even need reconvincing, of how absolutely crucial the issues are that you've raised. So we have about just under half an hour. Let me just see a show of hands. All right, we'll start here with, don't find me this roving mic somewhere.
So I guess my question...
Just one sec. Okay, this is being recorded, so if you don't want to be recorded, just don't say anything.
Keep it clean, Don.
I guess I'm wondering how well we understand the couplings between countries, and how much we have to understand them, or can we set things up so we don't really need to understand them to create a system that's going to be robust and stable. And to be specific, in this first example you showed us where the Fed did tapering, and then you saw the price of currencies of developing countries plummet, the bonds went way up. My first reaction was, my God, I'm really not on my toes, because I should have heard tapering and immediately gone out and bought and sold those things and made a lot of money from it, because there were big moves. So I'm wondering, is that just because I'm a dummy, or is it because it isn't so easy to understand the consequences of that? I mean, when the Fed tapered, were they saying, Bernanke saying, oh my gosh, we're going to screw these guys in developing countries by doing this? Do they understand that? And then secondly, how much can we do to understand it? Yeah. And how much can we do just to buffer it so that we can deal with it even if we don't understand it?
Yeah, yeah. So, did you all catch that question? Is that? To your 2 points, which is, can we better understand it, and can we better manage it? So, one of the great tragedies, not just of the last crisis, but of the previous ones, is that they were in the data. So, the global financial crisis was in the data. The Asian crisis was in the data. The Latin American debt crisis was in the data. Back in the 70s, the Bank for International Settlements began collecting quite comprehensive and rigorous data on cross-border banking flows and stocks. And the crises I mentioned were all in those data. And it was only after the fact people said, hang on a minute, it's in the data. And that is an uncomfortable, an ugly truth. Part of my answer is that actually some of the tools of the trade, some of the data were there to tell a story, but often we did not join the dots. It's back to the point where I started, that no one had quite joined the dots and told a story in which these things could connect together through global banking markets in ways that ricocheted globally. So I think that's part of the answer. But plainly it's not all of the answer, because those international banking flows cannot explain what happened after, for example, the collapse of Lehman Brothers. When we saw, for the first time ever, every country on the planet fall off pretty much the same cliff edge at the same time, the same amount. That's never happened before. And the answer, the explanation for that was not banking, because the pecuniary links between banks weren't large enough to explain that. There was something else going on. Call it psychology, but call it also non-bank flows, because that part of the financial jigsaw we have a very weak read on from a data perspective. Banking, okay, we regulate them, we monitor them. Anything of a non-bank nature, the fog begins to get really quite dense. And in this particular case, most of the outward flows were of a non-bank nature, portfolio nature, rather than a banking nature, on which we have only a rather inaccurate read. So in weak moments, I have this Star Trek vision, 10 years hence, of someone, maybe it's you, Don, actually, sat in a chair in some city, tracking in real time the global flow of funds. As this global financial web grows and contracts, things die and are born. You run stress tests. What happens if I knock out Lehman's? Does the world end? Now, right now, 10 years is optimistic because we are a world away from having the raw data to join the dots until a genuinely systemic pattern. But I don't see why that is unrealistic as a vision of where we should be. As you know much better than me, that is what we do for weather. That is what we can do for weather. And that has involved an incredibly intensive data effort as well as analytical effort over a 30, you're the expert on this, 30, 40-year period, yeah? For me, that data effort, that analytical effort needs to be every bit as great if we're to join the dots to create that Star Trek Captain Kirk moment where you are sat there surveying the global financial scene and shouting out warnings if things look perilous, spotting those fat tails, stress testing the world. So I hope that's a world towards which we can incrementally move. And at times I get very optimistic about that. There's this thing that you know lots about called the Office of Financial Research in the United States, whose aspiration was to do something a bit like this. But so far that aspiration has fallen somewhat short, and this is a purely US initiative right now. So we're not yet at the Star Trek point, but I remain hopeful that we might one day get there. If we can monitor, we can much better manage. And it's clear to me that all the buffering mechanisms I mentioned need to be rethought a bit, be it official sources or domestic debt structures.
Great. David, and then the gentleman there, and then we'll come around to the side.
Andy, what you described was largely defense measures against the picture that you drew of this stress over the last 6-9 months in emerging market economies as a result of tapering. And all of these defense measures are extremely important. Some in emerging markets, I think of Rakesh Mohan and others, have tried to point a finger at macroeconomic policy in advanced countries as putting the emerging market economies into a global financial credit cycle problem that they can't deal with. If only you hadn't done QE, we wouldn't be here, is what Mohan as others have said. Of course, if we'd had more expansionary fiscal policies for the last 3 or 4 years, the burden on QE would have been less. And we might be in less of this position if the fiscal and monetary balance had been different. Maybe you can't say much about that, but is there that or anything else that we could do as advanced countries that makes the emerging market economies problem likely to be less?
Yeah. So I'll resist the temptation to do fiscal policy.
Yeah.
In fact, I might resist the temptation to do monetary policy as well. But the issues you raise, David, as ever, I think are right on the money. I think the important thing to say here is that I don't think there's anything that's been done by advanced economies or emerging markets that wasn't with the best of intentions, whether it's supporting activity or constraining credit or whatever it might be. This knocking of heads that I mentioned at the beginning, between those creating the money and those that are receiving it, I can understand the arguments on both sides. I think what we need as an absolute minimum is some greater recognition that these spillovers, be it from advanced to emerging or emerging to advanced, it happens both ways, of course, are potent, are important. Yeah, in the same way as the Fed's actions today are reshaping monetary conditions in emerging markets, there's no question that the actions of emerging markets were reshaping monetary conditions in the US prior to the crisis. This is absolutely two-way. I think a starting point, before we get on to should we coordinate, is a recognition that these spillovers are potent, a recognition of how potent they might be. I think if you have that, start with that base of knowledge, of understanding, of recognition of the spillovers, there's greater chance of a dialogue about how best to manage them. That could be through multilateral measures, it could be through unilateral measures. But right now, there's denial on both sides that they exist, I think.
The gentleman with the...
Thank you. I'm not an economist, so apologies if this is a naive question or if I missed the answer within your talk. Early on, after you showed the tapering talk slide and then the impact on the emerging countries' currencies. And I was looking for the BRIC countries, and I think I saw Russia and India, and I think I saw Brazil, but I didn't see China. So the question is, did it have an effect, a similar effect on the Chinese currency, and if not, why not?
Yep. So, should we call the picture up? Oh.
Difficult.
China has a somewhat different exchange rate regime than the other countries I mentioned. It's a gracious. It's
I'll leave it off, Clara.
That was my fault. Sorry. So there's a largely managed or semi-managed exchange rate regime. So the pressures would have been less felt, and they have restrictions on capital movement. So the pressures wouldn't have manifest as obviously in the RMB exchange rate as they did in other countries. So that was one reason for not including.
If any of the other countries would have a similar or partially similar regime, would they have been able to avoid some of the effects of the adversity of the talk, of the tapering announcement?
Yeah. So let me try and answer your China question and then answer your follow-up as well. So China is plainly an important part of this story. And one of the catalysts, contributors to the frisson within emerging markets last week was news out of China, which wasn't especially positive. There was problems with their shadow banking system. There was some real economy data that was weaker than expected. So China is a part of the story, a part of the spillover story. I think, take your country. So I think a third of South African exports go to China, I think. So one of the reasons that South Africa suffered a bit last week on the exchange rate and the volume was not just a QE US tapering thing, but a China thing, a China story. So China is an important part of the story, but it's in a somewhat different position than the South Africas, the Turkeys, the Argentinas and the Indias, all of whom have had to raise interest rates in the past week to protect their currencies.
Okay, this side, gentleman in blue.
Thanks. I was just wondering, so how do you think we sort of balance and manage the need to deal with systemic risk, but sort of balance that with individual countries' needs? So taking the US example that you gave, they obviously have an optimal policy they're following for their country.
Yeah.
How do you sort of implement a system that allows other countries to be taken account in that?
Yeah. Well, I think it is hard for any individual country, especially a big one, to fully reflect on the consequences of their actions for the rest of the world. So I think those that argue that all we need is there are these proposals, we need some sort of equivalent at a global level of the Monetary Policy Committee here in the UK, where we'd all sit round and decide how to set kind of global monetary policy. And that is obviously not going to happen short of global government. I think global government's still some way off. So I think that's unrealistic in terms of where we might get to. Where we could get to, or a role that the IMF, for example, could play, however, would be to be very clear in raising a flag about the spillover consequences for the rest of the world of a given country pursuing a given policy. And to weigh that in their assessment of what that country should or shouldn't do. I think that's realistic. It's sort of soft cooperation rather than hard cooperation, but would at least be a step, I think, in the right direction. Because I go back to the point that if we can agree that these effects are big, we can hopefully also agree to do something about it. That something might not be people setting a different course of monetary policy, but it might be putting in place more insurance for those that are caught up in the backdraft. And that was the spirit of the suggestions that I made.
John?
In the UK, the ONS is very heavily financially constrained, and the ONS admits that the flow of funds data domestically are not adequate. In the US, the Federal Reserve plays a major role in creating and managing statistics, financial statistics in particular.
Yeah.
Is there some possibility that the £18 million saving that the Bank of England is going to make, that some of that might be redeployed towards improving at least the domestic flow of funds data?
So, thank you, John. So, to answer your question in two parts, the first part is, well, I'm completely at one with you on the need for the UK to up its game on flow of funds data. As I was discussing with Ian just earlier on today, actually, it would be remiss as the world's premier international financial centre for us not to have a better picture of the two-way flows of funds in and out the country than we do right now, and we are some way off the pace relative, as you say, to the US. So on that, I couldn't but agree on the need for us to do quite a lot better. On the question of who pays, well, I mean, it's not for me to spend the 18 million. It's not my 18 million for one thing. But do I think a way should be found to finance an improvement in our understanding of financial flow funds domestically? Absolutely. I was just saying to Ian again earlier on today, someone came into the bank a couple of weeks ago to give a talk, and he said, I was looking at the US flow funds data, at the biggest flows in and out of the US over the most recent period. And the top three, two of them were Chinese purchases of US treasuries. And the third was UK purchases of US corporate bonds. And I didn't know that. And that doesn't feel like a comfortable position if you're executive director for the Bank of England. So yes, I think absolutely on whether it should be done. I'll leave the financing arithmetic to someone else.
Hi. Yeah, so your answer to kind of the systemic risk is insurance, and the textbook response of an economist is, doesn't that create some kind of moral hazard, in the sense that, you know, insurance is great if you're guarding the system against external shocks, but as soon as people have something to do with how risky things are, and if they're clever enough, they're going to find a way to take more risk. So, I mean, government might have an incentive to pursue a riskier policy given that there's now better insurance. So how do you make sure you don't end up with a system that's better buffered but also riskier?
Yep.
And you know, it's a bit related to the Star Trek guy who says that when Doyne says, guys, things are getting out of control, anybody's going to listen. It's also related a bit to the soft versus hard cooperation. But
Yep.
Yeah.
Yep. So some of the measures I mentioned weren't insurance in the classical sense. They were self-insurance. They were self-help measures, and they don't fall foul of the same problems. So whether it's, you know, putting your debt structure in a better place, or building up your reserve stock to guard against the risk of outflows. That doesn't fall foul of the same critique, moral hazard critique. Plainly, multilateral facilities do prospectively fall foul of or give rise to the possibility of moral hazard. Of course, every insurance contract has moral hazard. It's impossible to get rid of, impossible. The question is, how much is too much? And I think it is possible to design multilateral facilities which strike a reasonable balance between the flexibility to provide quick financing while guarding against the moral hazard risk that you mentioned. I mean, one idea that emerged from the Asian, Latin, Russian crises was that we make available ex ante facilities to countries. Because typically the way IMF works is that crisis strikes, country goes into denial for a period, IMF arrives on the scene too late and distributes. So a different way of running that game is for a country to apply for a facility, a credit line if you like, in advance, based upon its fundamentals being sound rather than not sound. If you like, protecting the innocent bystanders from the effects of future shocks. And in principle, such facilities which the fund put in place, so-called flexible credit lines and precautionary liquidity lines, were intended to do just that and would have helped guard against some of the moral hazard concerns that you rightly raise. The problem has been very few countries have taken up this option. Only 4 to date have done so, to the point where the facilities of anything have become a bit stigmatized. So I think this needs rethinking and us seeking a means of providing support that's flexible enough so that countries aren't scared off in advance and aren't in denial after the fact in a way that guard against moral hazard. I think that's possible, if difficult. When Stan gave his paper on international last resort in 1999, I was one of those that was saying this is risky for moral hazard reasons. I was writing papers on moral hazard, international lending at the time. I've changed my mind. I think I was wrong and Stan was probably right.
Hopefully Stan will be back soon and that debate will continue. All right, let's have a quick show of hands. We've only got time for 1 or 2 more questions. The person over here, I think those two have the line. Why don't we take both questions and that'll bring the questions to an end.
So do you think there's a conceptual distinction between the international versus the global monetary system? So I'm not talking here just about also financial centers, but also about unrecorded flows which are neither between nation-state entities. Thank you.
You couldn't just elaborate a little bit, could you? I'm missing the...
You can think either of offshore financial centers,
okay.
but not just about them, but also about off-balance sheet flows. For example, the BIS said that these should be included in the BIS data.
Right. No, quite so. I think...
Grab both questions.
Yeah, absolutely.
The proprietary trading of banks worldwide is very well regulated, or will be, let's say, will be regulated quite properly. However, the big movements, the commodity markets are not regulated, the derivatives markets are not regulated, the hedge funds are not regulated. So, you know, how good is the system? You can say that whatever flows, whatever monetary flows a commodity trader creates or a hedge fund creates is shown up at banks, but it's not their proprietary trade. They're just fulfilling out customers' order, and this is not regulated. The Chinese transfer money outside China through derivatives. So they bet They do a weather derivatives in Shanghai and the counter weather derivative in Zurich and transfer billions out of it. It's like a bet which they lose in Shanghai and a bet which they win in Zurich. So there's no cross-border money flow even. There's no flow. But they transfer money out without a flow across borders. So how do you regulate that?
Yeah, yeah. Those questions got really nicely, actually. Well done, Ian. So, it's certainly true to say that, to give your two examples, the derivatives market and the commodities market are neither are formally regulated. Of course, many of the participants in those markets are regulated, and many of the transactions in those markets, and the activity in those markets is monitored to guard against market abuses of various types. So there is already some degree of regulation of the players and the activities in the two markets you mentioned. And in particular on the derivative side, one of the great reforms that's moving through the system right now is to ensure that so-called over-the-counter derivatives, including some of the more exotic stuff, is in future so-called centrally cleared and traded on exchange, which means, in essence, that those transactions will be more visible than they would have been in the past. So all of these are bits of regulatory reform that will shed light on what are, I agree, currently sometimes murky bits of the financial system. But nonetheless, the question that both you and the other questioner raised, I think, are perfectly legitimate. There are parts of the system that remain in darkness, or that remain at best dimly lit. Derivatives you both mentioned, and it's certainly true that our monitoring of derivatives activity and our understanding of it is not what it might need to be to fully get at the risks. You both mentioned hedge funds. They are a part of the financial system about which we know materially less than is the case, for example, with banks. Should we do a better job of trying to track those flows of funds, be the players banks or non-banks? Absolutely yes. Would I jump to a position of regulating those entities? I'm not sure. That might at the moment be a step too far. But the one thing I would say, and again, going back to lessons from the crisis, one of the big ones for me is that regulation, not just what you do, but who you do it to, needs to be much more fleet of foot than was the case in the past. We know the players in financial markets are fleet of foot. We know that risk will migrate to where regulation is least. And we as regulators need to do must be much faster on our feet to say, look, risk has migrated. We therefore need to look, or indeed, on occasions, regulate to guard against that risk blowing out. That is what the whole shadow banking agenda, so-called, is about. But the generic lesson is we can't sit still. Financial markets will not sit still. So we as regulators need not do so also. Charles Goodhart, the economist Charles Goodhart, has this nice metaphor about how tricky it is to be a regulator. He says this is effectively bloodhounds, that's the regulators, in pursuit of greyhounds. And that, again, feels quite uncomfortable. In the past, it's been true, and the bloodhounds need to speed up, because the greyhounds won't.
Great, Andy. You deserve to have a seat. But thank you very much. Just before we get to thanking Andy, again, I would encourage you to to look at his papers, and a fantastic example of how one really can do interdisciplinary work. So, for example, his paper with Lord May here, who's a professor of zoology, on ecology for bankers, is just one of the many examples of how one can cross over between different fields to get great insights, which we're always striving for here. There's a whole series of events coming up at the Oxford Martin School, which we would encourage you to attend. The Saturday the 15th, a wonderful group of students are organizing a whole day event in the Sheldonian, which look at our website for further details of. Monday the 24th of February, Kumi Naidu, the Executive Director of Greenpeace, asking direct action when and why. And Baroness Helena Kennedy celebrating International Women's Day on the 6th of March on the fight for women's rights. And then at the Oxford Literary Festival, we have a whole series of other events. Do also come to our seminar series on Thursdays at 3:30, focusing on the interface of machines and human intelligence, with a really great series every Thursday at 3:30. It remains for me to thank Andy for a fantastic talk. Thank you all for coming. And as we were all talking about the importance of liquidity in the system, you are all invited for a drink next door. But thanks to you, Andy.